Welcome to today's lesson. My name is Garth and I come from Zenithora Elevate Partners. This is an academy where we have different types of topics when it comes to trading. So we discuss different types like trading psychology, market structure, and also risk management plan. So let's come to today's topic. Today's topic is very interesting. We're talking about trading psychology and then the trader's mind. So today you can just open your book, you can just take notes on this. If you want to connect with Zenithora, we'll send you a link right there in the description. Just go to that link. You'll be able to get more details into Zenithora. So guys, what is the trader's mindset? So strong psychology principles for disciplined, consistent Forex trading. So these are the topics or the subject that we're going to be discussing is your mindset as a trader. So let's go straight into the points. So the foundation of trading is that strategy doesn't fail, discipline does. So you can have the most perfect strategy, but if you don't have the right discipline, having disciplined rules and following a trading plan, you will definitely see some sort of losses that come rapidly. So in the first paragraph, I said a perfectly calculated position size, a technically sound stop loss, and a proven strategy mean nothing. The moment you fear, the moment you apply greed or frustration overrides them. So, psychology is not separate from risk management. It is the operating system that determines whether every other rule actually gets followed. So, if you don't have a good psychology, even the risk management plan wouldn't be much of use. So, let's go to our next point. So, there are four forces that hijack a trading plan. Every trading plan has something that it hijacks. It's either fear. Fear exists winners too early. You exits winners too early. If you have so much fear that the trade might reverse or the trade might just go the opposite direction, you will definitely hesitate. So fear, it causes you to exit winners too early. It hesitates on valid setups. So you have a good setup and you see that the setup is valid. Instead of you waiting for the setup to play out, you either decide to exit or just fear taking that trade because you have fear. So another force that causes or hijacks a trading plan is greed. You have a solid trading plan, you have a target amount that you're going to be taking this amount after this trade, or your target area is to exit here. And if you see that if you read there, I said overrides target. You have a target and now you forget about your target. Oversizes, you put more lot sizes, you increase your lot size position, and then you feel like, okay, I can maybe make more from this. So it oversizes positions that feel certain. You have a certain amount that you said, okay, I'm opening 0.01. Now that you see the market is going in your direction, you feel that, okay, you have to increase lot size. So let's go to the other point that hijacks a trading plan is revenge trading. Most of us traders, we go into this, especially if we believe into a certain direction. So it's impulsive re-entry. You see a buy, the market takes you out, and you re-enter immediately right after the market takes you out. Even before weighing out how the market is performing, you just re-enter. So the impulsive re-entry after a loss to a win to win it back fast. So you just suffer the loss and you go in the market one more time to recover the loss that you made. And the fourth point is that overconfidence. You're so confident in your trading plan. You're so confident, not in your trading plan, you're so confident in your strategy. So this grows quietly after winning streaks. So that's why you should always be logical when you take a trade. Remember that yesterday's trade is not tomorrow's trade. So tomorrow's trade can be a loss. And do not be overconfident that you even disregard your trading plan. So let's go to the fourth point. The fourth point is that I did mention here the first force is fear. So how do we recognize fear? Cautious disguise for hesitation and premature exits. So that's the subtitle for that. So the first point is that closes trades well before the planned target out of anxiety, and the market will reverse. So you have anxiety, like I mentioned before, that the market will reverse, you just come out of the trade. So the second point is that damages the risk to reward math, a strategy valid, or a strategy was built on. So damages the risk reward math a strategy was built on. You said, okay, I'm taking a buy now, I'm above support, and I'm going to exit in the next resistance level. So you fear doesn't allow you to hold up to your desired plan. So you just come out before it even does anything. So causes hesitation. We did say that when you have fear, you have hesitation, even in a valid setup or a valid plan, because plan compliance setups are after a recent loss. So you don't you don't comply to your setup. You just exit because fear just lurks in. So fourth point is that often shows up physically tight chest, shallow breathing, raising heart on an open trade. So when you have fear, you'll feel that tight chest, you'll feel that shallow breathing because you're so fearful what may happen. So you see your heart raising as you open a trade. Those are the symptoms of fear if you are taking a trade with uncertainty. So what you can do, let the plan decide, not the moment. So this is what you can do, countermeasure. The countermeasure is this: let the plan decide. Do not be shaken by the moment that, okay, I'm feeling a bit scared. Let the plan decide. So set the take profit target before entry. Always set a take profit or take an exit before you take an entry. Now you already know where you're going to exit. And then based on a real technical structure, do not just say I'm going to exit at 4,500 without having any reason as to, do you have anything that you can point that there is a resistance or level of support there by 4,500. And then another thing, and leave it alone. After taking a good trade, leave that trade to run. If a setup meets every item on your checklist, take it regardless of how the last trade felt. So if everything is confirmed and you see that there is a buy opportunity, take that trade. It won't go the opposite direction without you can't be speculating what's going to take place way before you take a trade. So if you see any confirmations and you see that you are able to take a trade, just go with the plan. So greed, we go to greed. So this is force number 2, the force that many traders fail to get rid of. So fear is confidence. Confidence is disguise of abandoning the exit plan. So this is what I said earlier. You hold winners well past the planned target. Your target was to exit at 400 Rand, and now you're still holding to that trade because you have so much greed. You feel like you can even make more. So chasing an even larger gain. You are chasing a larger amount. So that's why you wouldn't be able to exit. So point number 2, increases position size. This is what most of us we do. After a good trade, the market is going good in our direction, we increase our capital, and now we feel more confident, we increase the lot size. So the calculated amount, because the setup feels certain. This is, you feel certain about the trade, and then you just increase the lot size. So third point is that enters trades that don't meet the written plan, simply because the momentum looks exciting. You just had a good trade and the momentum feels so good, you feel like you can just enter more trades. Peaks quietly after a winning streak. So exactly when God's is low. So peaks quietly after a winning streak. So you increase greed because you just had 4 winning trades and you feel like, I can keep up with this momentum. So countermeasure to this, the target you planned is not the target you take. The target you planned is the target you take. Yes. The target you planned is the target you take. If you target to make 400 rand, take at least 70% of your target, so that if you feel like holding on to a trade, then you have exited with the targeted amount. So removing a take profit order mid trade to let it run is a plan change. If you remove a TP and then you want it to run more, you change in the plan. So instead of removing the trading, the take profit, take 70% and let others trade and let other trades run. So we can go to point number 6, slide number 6. Force 3 is revenge trading. So revenge trading is when the market didn't take your money back. So revenge trading, the market didn't take your money back, you gave it away trying. So revenge trading is you going in and out now and then in the market. A loss occurs and then you go in again. Emotional edge. So these are the 4 points, or the four movements that takes place in a revenge trading moment. A loss occurs, emotional edge to win it back, oversized, unplanned re-entry, and compounded losses. So you find that your losses are compounding because you have so much emotional urge to win it back. So breaking the cycle. How do you break the cycle of revenge trading? Mandatory cooling off period. If you feel like you are struggling to break away from revenge trading, take a cool off period. Any loss beyond normal planned risk. If you have more losses than your planned risk, take a cool off. You can take a cool off by doing some exercises. You can take a walk. You can say to yourself you're taking a 2-hour break from watching the charts. It will help you take a break. So physical step away from the screen before considering the next trade. This is what I just said. You walk away from the screen before you execute another trade. So a written checklist that must be satisfied before any new entry. So write down your next entry plan. What are you looking for before you execute another trade? So a hard daily loss limit that leads trading for the day. No expectations. So no exemptions. So set a hard limit. Say that today I'm risking only 200 rand. I'm risking only 500 rand, and you stick into that. So let's go to the 7th slide. Overconfidence. This is the last force that causes you, or that hijacks a trading plan. Revenge trading's quieter, more dangerous cousin. So dangerous cousin. So overconfidence is revenge trading closest brother, or you can say it's a cousin. So where revenge trading is driven by the discomfort of a loss. So the revenge trading is driven by the discomfort of a loss. And then overconfidence is driven by the excitement of the recent success. So they are mostly similar to each other, but oppositely so. So it develops gradually after a winning streak. After a winning streak, you need to keep to your playing plan, not changing anything. So as skill gets credited for what may partly be normal statistical variance, and risk taken creeps upward almost invisibly. So this means that you don't really consider the risk that you take because your confidence is so big right now, and you feel like you can even win with bigger lot sizes. So there at the bottom I said treat an unusual strong winning streak with the same structured caution as a losing streak. So don't change your plan because of a winning streak. So let's go to the 8th slide. Case in point. So one loss rarely travels alone. So how the 4 forces compound within a single trading session. So this is why you witness losses compounding throughout one trading session. A plan compliant to trade losses. So a plan compliant trade losses. A normal expected outcome. Frustration builds and unplanned re-entry follows. A third trade is closed early from anxiety about reversing fear. So fourth point, a strong looking setup is oversized after a quick win. So a single pause after the first loss, stepping away, reviewing the plan could have prevented the entire chain. So this is the chain that takes place, especially when those four forces are actually in place. So let's go to the second slide, the ninth slide. The response. Discipline is a habit, not a willpower contest. So these are the 6 points that you need in order for you to see discipline in your trading career or in your trading life. Written plan. Define entry stops and targets before emotion has a vote. Write a trading plan. And then the second point, trading journal. Log the emotional state behind every trade, not just the numbers. So log the emotional state. How do you feel after taking that trade, after taking that win? And then not just the numbers. Do not check that you just made a big win or that you just made a substantial loss. What are the emotions involved? So predefined limits. Daily loss limits and position sizing act as automatic circuit breakers. So these are the things that are going to help you keep the discipline. If you set daily losses and then you set automatic position sizing, not automatic actually, if you set position sizing that you know your account can bear, it will automatically break the habit of you doing revenge trading or complying to those four forces. Regular review, spot recurring patterns. After you see yourself doing the same thing, spot recurring patterns away from the pressure and open position. So if you do a regular review, it will break away, it will help you spot those recurring patterns because you will see this is what you normally repeat and you can easily change that if you are aware of it. So accept the cost. Treat losses as a normal expense of the business, not personal failure. So losses are just part of the game. You can't break them, you can't run away from them, you can't do anything. The only thing you need to understand this is that losses are part of the business, and then they are not a part of your personal failure. It doesn't mean that you are a bad trader. It means that losses are part of the game. So cooling off rule, a fixed pause after an outsized loss. Take a break, a day or take a week. It all depends on how long you need to take a break before any new trade is considered. So let's go to the next slide. We are very close to finishing this lesson. So practical tool, the pre-trade emotional check. Before taking any trade, before any entry, ask yourself before every entry, out aloud if it helps. You can even shout this thing or you can just shout it in your brain. I never shouted myself asking myself this question. I would rather look at the position or the entry and ask myself these 5 questions. So the first question is that does the setup meet every item on my written trading career or trading criteria? Is it on your trading plan? Have I calculated position size from my stop loss, not the other way around? So you need to find out how much you're losing, how much you're risking. Does this meet my minimum risk to reward requirement? And then, am I within my daily and weekly loss limits right now? And the last point is that, am I entering because of analysis or because of my win or last win? Or even a loss? So let's go to the closing of this lesson. Remember that protect your capital. It protects your capital. Protect your mind. It will protect your capital. Protect your mind, it protects your capital. So if you protect your mindset, you will know that it will protect your capital. Protect your psychological mind in trading, and then it will protect your capital. Every technical rule in your trading plan is only as strong as your ability to follow it under pressure. So master the four forces: fear, greed, and revenge, and overconfidence, and your discipline becomes your edge. So thank you very much, guys, for tuning in. This is Zenithora Forex Academy. We are an educational site for traders, beginner traders, and also those that have been in the market for quite some time and that